Hello, Super Saver. I hope you're doing well. So one of the most popular questions recently has been, should I buy 4-week, 8-week, or 12-week T-bills? Or perhaps 26 or 52-week T-bills, maybe even throw in some Treasury notes. And it's no surprise with the 2-year Treasury yields hitting over 4% recently, the highest level since 2007, as you can see from the CNBC article. So if you've maxed out your I-bonds for the year and or are slightly nervous about putting more money into an already unpredictable stock market, the low risk and current rising yields of treasuries may be worth taking a look at. I certainly thought so. In today's video, I'm going to show you the $60,000 Treasury bill ladder that I built in one of my retirement accounts after the Fed's most recent meeting, including which T-bill maturities I purchased and why. The factors that I took into consideration when building out my T-bill ladder, factors that someone, depending on their circumstances, could similarly apply to building out their own T-bill ladder or even CD ladder or bond ladder during these times. Plus, I'll show some examples of other T-bill ladders that you might want to explore for your portfolio. So without further ado, let's dive in. For those of you new to T-bills, here's a quick recap of my top 5 reasons for buying my $60,000 of T-bills right now. T-bills are typically paying better rates than most bank CDs currently. You don't have to pay state or local income taxes on T-bill interest earned. Yes, that does mean that you do have to pay federal income taxes on that interest. T-bills are low risk, given that they're backed by the full faith and credit of the U.S. government. They have high purchase limits. At the moment, the limit for retail investors like you and me, it's essentially $10 million per auction for each security type and term. T-bills are liquid. They can be purchased and sold in the secondary market. Just keep in mind that this liquidity may come at a price. If market conditions are not in your favor, for example, if interest rates keep going up, you may get back less than what you originally paid for your investment if you sell before the T-bills mature. If you want more details on some of these points, check out the first half of this video here on how to buy T-bills. I've linked it below as well. Please do note that my T-bill ladder is based on my specific circumstances and market perspective, which I'll talk about shortly after this. Yours may look a little or perhaps even a lot different, but hopefully the factors that I took into account when building out my Treasury ladder will help provide a perspective for you to figure out what's best for your personal situation. So here's what my T-bill ladder looks like. What I bought in September: $20,000 of 4-week T-bills, $20,000 of 8-week T-bills, and $20,000 of 13-week T-bills. And here, this is the rate I got for the 4-week and 8-week. And this is the expected yield that Fidelity gave me for the 13-week. As of this taping, that 13-week T-bill auction has not happened yet. So I don't quite know what the actual yield will be. In 4 weeks' time, in October, when this $20,000 of 4-week T-bills from September matures, I'll reinvest those proceeds into my next 13-week T-bill and presumably, given the current environment and interest rate sentiment, at a higher rate than the previous T-bills. And in 8 weeks' time, in November, when this $20,000 of 8-week T-bills from September matures, I'll do the same as I did in October. Reinvest those proceeds into another new 13-week T-bill. Again, hopefully with higher rates. And I'll keep doing this every 4 weeks while interest rates keep going up. Because as you can see here, from December onwards, every 4 weeks, every month basically, I'll have a new 13-week T-bill that's maturing. I chose these T-bill maturities for 2 main reasons. Reason 1, I'm assuming that interest rates will keep going up. Jerome Powell basically said this outright in the most recent Fed meeting. Here's the transcript from that meeting. He said that they would keep raising interest rates and tightening monetary policy until inflation is under control again, back to the target rate of 2%, where it's been on average for the past 2 decades. And my expectation, like some others in the market, is that this will not be achieved overnight and will go on until at least early, potentially mid-2023. Or it might last even longer if the current inflation proves more entrenched than the Fed is assuming now. So in my case, every 4 weeks, I'll be freeing up cash in my portfolio to reinvest in a new 13-week T-bill to take advantage of new higher rates. But why not a 26-week or 52-week T-bill, or perhaps even a 2-year Treasury note, given that those rates are even higher? These are the rates from the U.S. Department of the Treasury as of the time of this taping. As always, the link is below the video. The link will take you to this page, and if you click on Data and then Daily Treasury Par Yield Curve Rates, this screen will pop up afterwards. Scroll down to whatever the date is that you're searching for, and that's where you'll find the most current rates. This won't tell you exactly what rate you'll get at auction for your T-bills, but it does give you a sense of what you could expect. So going back to the question of why I didn't go for longer-term T-bills or the 2-year Treasury note, given their higher rates, that's because of reason 2. I want flexibility and liquidity. As I mentioned earlier, every 4 weeks, I'll be freeing up cash in my portfolio to reinvest in a new 13-week T-bill at presumably higher rates. But what if things change and I decide I want to invest in something else altogether? We've all seen how crazy, how volatile the markets have been lately. Assuming that I live as long as the average woman, hopefully, which these days seems to be around 80 plus, maybe I'll live even longer if I eat those 4-piece McNuggets a bit less often. Anyway, because I do assume that I will live a few more decades, my investing horizon is typically long-term. And long-term, I still believe that the stock market will give me the most bang for my buck. So every 4 weeks starting next month, before my next T-bill matures, I'll see whether it makes sense to roll that maturing T-bill over to the next 13-week T-bill, or whether I'll be heading back into my faithful index funds, or perhaps even a longer-term Treasury security, depending on where rates are and how the market is doing at that time. Again, that's my situation. Yours may be different. So let's talk about what factors I took into consideration when building my T-bill ladder and how this may help guide you in building out yours. I'll also show you some examples of other T-bill laddering strategies for a bit more financial inspiration. The first factor I considered was how much do I want to invest? For me, the amount was fairly easy. It was simply cash in a rollover IRA that I didn't feel comfortable throwing in as a lump sum into the stock market right now. It's not money that we're dollar cost averaging into our current retirement or HSA accounts. Not money from emergency savings that we may need in the coming months. And not money reserved for I-bonds to inflation-proof some of our portfolio. Not borrowed money either. Figuring out how much you have to invest is important because laddering does require a bit of investment capital, given that T-bills, as well as Treasury notes and bonds, they're sold in minimum amounts of $1,000, or in some cases even $5,000, depending on the brokerage company you use. Of course, if you want to ladder in smaller amounts, you can buy via Treasury Direct, where the minimum purchase amount is $100. Moving on to the second factor that I considered, which was what is my time horizon? When or how often do I need or want that money out of this ladder? As I said previously, my time horizon is relatively short in this case. I want to be able to move my cash out of this ladder every 4 weeks if I choose to, in the event that I find better investment alternatives elsewhere. Now, if I had a longer time horizon, say 8 weeks instead of 4, I could use this 26-week T-bill laddering strategy that David Enna of TipsWatch recommends in one of his recent articles. In this case, I'd essentially make 3 purchases of 26-week T-bills with 8 weeks between each purchase. I've linked the article below for those of you who wish to explore this further. Now, the third factor that I considered when building my T-bill ladder was how much time do I have to do this? And the answer was not very much. So I kept my T-bill ladder fairly simple. I could have made it more complex, but the more complex I made it, the more time I'd have to spend building and managing it. Here's what I mean. Say that I wanted to buy 26-week T-bills to take advantage of their slightly higher yields, but I also wanted the flexibility of being able to eventually cash out every 4 weeks. Here's another possible T-bill laddering strategy that I could have used that combines this flexibility with that slightly higher yield on the 26-week T-bills. Again, let's assume we're starting with $60,000. This month, in September, I'd buy my first 26-week T-bill for $10,000. In October, I'd buy my second 26-week T-bill for $10,000. In November, my third, and so on for December, January, and February, until I've invested all $60,000 of cash. Now, in March, when my first 26-week T-bill matures, I can reinvest those proceeds into the next 26-week T-bill. And in April, when my second 26-week T-bill matures, I'd reinvest those proceeds in the same manner into another 26-week T-bill. And I just keep doing the same thing as each one of these matures until I find something else with a better return. As you can see, this does require more effort and time. But if you're okay with it, it is another T-bill laddering option you could consider. There are truly many different ways to build out a T-bill ladder. Drop a comment below if you want to share with the community what your ladder looks like or how you're planning on building it out. And listen, I used a $60,000 initial investment for the laddering examples here because that's what I put into my T-bill ladder. But you can start with whatever amount works for you. The same basic principles apply whether you're putting in $6,000 or $600,000. And with larger investment amounts, you could make your ladder even more complex, even more diversified. So here's the fourth factor that I considered when building my T-bill ladder. Will I hold my T-bills to maturity? My answer was, of course, yes. But what's your answer? Do you have what it takes to hold a 4, 8, 13, or even longer-term T-bills or notes to maturity? Because as I mentioned at the beginning of the video, if you don't, and you end up selling those T-bills before maturity in the secondary market when interest rates are rising, you will, all else being equal, get back less than what you originally paid. So if you think that there's a chance that you may do this, laddering may not be the best way to go for you. If, on the other hand, you're now all pumped up and ready to add some T-bills to those I-bonds, stocks, and or whatever else you own, then check out this video here on how to buy T-bills. I'll walk you through how to do this via Treasury Direct and Fidelity and why you might want to choose one over the other. As always, my super saving fans, I hope this video has given you some food for thought on how to go about crafting your own T-bill ladder. If you enjoyed this video, don't forget that thumbs up and see you again soon with another exciting wealth building video.